In severe cases, not filing your ITR can lead to prosecution. This can result in imprisonment, a term ranging from 3 months to 2 years, and in extreme cases, it can extend up to 7 years. Hey everyone, welcome back to my channel. If you're new here, I am CA Isha Jaiswal, and today we are going to talk about something that might seem very complicated but is very important, which is ABC of income tax returns or ITRs. Here in this video, we'll cover different types of ITR, who needs to file which one, why filing your ITR is crucial, and what can happen if you don't file your ITR or delay filing your ITR. This is a comprehensive guide, so watch the video till the end. So let's start with the basic things. What does ITR stands for? ITR stands for Income Tax Return, a form which you should have to submit to the Income Tax Department that carries information about your annual income and taxes you are liable to pay on the income you have earned during the year. So let's check whether you have to file the ITR or not. So filing of ITR is mandatory if your income exceeds the maximum amount which is not chargeable to the income tax. So for example, if your income is rupees 2.5 lakhs and you are an individual of 60 years, you need not file an ITR. But it will be mandatory for you if any of this condition becomes true. So if you are a resident, an ordinary resident in India who holds any asset including financial interest in any entity located outside India, or you have a signing authority in any of the account within India or any account outside India, or you're a beneficiary of any asset including a financial interest in any entity outside India. Next, you are an individual and have deposited more than 1 crore in aggregate in your current bank account. Third, if you have incurred electricity expenditure of more than rupees 1 lakh. Fourth, if you have spent more than 2 lakhs on foreign travel. Fifth, if your total sales turnover is more than rupees 60 lakhs. Sixth, your professional gross receipts exceeds rupees 10 lakhs. And seventh, you have deducted TDS and TCS of rupees 25,000 or more. And the last, you have deposited rupees 50 lakhs or more in one or more savings accounts. Now, what all do you need to file your ITR? Form 16 or salary certificate which your employer gives. Second, Form 26AS which shows TDS deducted and paid. So the steps to download the 26AS is mentioned in the description below. Third is AIS or Annual Information Statement, which carries your financial transaction details through which you can cross-check your ITR. So the steps to view the AIS is mentioned in the description below. Don't forget to check it out. Fourth is interest certificate issued by banks. Fifth is life and health insurance receipts. Sixth is bank account statements. Now, let's go over to the different types of ITRs and who should file them. There are several types, but we'll be focusing on some of the most common ones. Number 1, ITR 1 or Sehaj. This is specially for the individuals who have total income of up to rupees 50 lakhs from salary, one house property and other sources of income like interest and agriculture income up to rupees 5,000. So for example, you're an employee with a salary, some interest income from a savings account and small amount of agriculture income. If your total income is less than rupees 50 lakhs, ITR 1 is the right form for you. Second is ITR 2. This is especially for the individuals and HUFs. HUFs means Hindu Undivided Family, not having income from business or profession and who isn't eligible for filing ITR 1. This includes income from salary, more than one house property, capital gains and foreign assets. So for example, if you are a salaried employee with income from more than one house property or have earned some capital gains from the sale of shares, you should use ITR 2. Third is ITR 3. This is for the individuals and HUFs having income from proprietary business or profession. So if you run your own business or practice a profession like being a doctor or a lawyer or like a CA like me, ITR 3 is the go-to form. Fourth is ITR 4 or also called Sugam. This is for individuals, HUFs and firms other than LLP, mind that other than LLP, with a total income up to rupees 50 lakhs and having income from business and profession, which is computed under section 44AD and 44ADA or 44AE. So if you're a small business owner or a freelancer like me with a turnover less than rupees 50 lakhs, and if you want to take advantage of presumptive taxation schemes, then ITR 4 is the firm for you. Fifth one is ITR 5. This is for firms, LLPs, AOPs, BOIs and others. So if you run a partnership firm or an LLP, you need to file an ITR 5. So sixth is ITR 6. This is for companies other than companies claiming exemption under section 11 of income tax. So if you own a private limited company, you should file ITR 6. Now moving on to ITR 7. This is for the people, including companies, required to furnish return under section 139(4)(a), 139(4)(b), 139(4)(c or 139(4)(d). So if you run a charitable trust or religious institution, you need to file ITR 7. Now that we know that the different ITRs, let's talk about why is it important to file your ITR. Filing your ITR is a legal obligation under Income Tax Act. Failing to do so can result in legal consequences including fines and penalties. Second, your ITR serves as a proof of income and tax paid. This is very important when you are applying for loans, credit cards or even visas. Banks and financial institutions often require ITRs as proof of your income. So having a consistent record of filing ITRs can make it easier to get loans and visa very smoothly. It shows that you're financially responsible and you have a steady source of income. It also allows you to carry forward losses to future years. This can help in reducing your tax liability in future years. Now, it also helps you to avoid penalties and interest. The Income Tax Department charges a penalty of late filing and there can be interest on any tax due. Not filing your ITR can lead to several negative consequences. The Income Tax Department can levy a penalty of rupees 10,000 if you fail to file your ITR by the due date. So if you owe taxes and don't file your ITR, you will have to pay interest on the outstanding amount. This interest is typically 1% per month. In severe cases, not filing your ITR can lead to prosecution. This can result in imprisonment, a term ranging from 3 months to 2 years, and in extreme cases, it can extend up to 7 years. So if you are eligible for a refund but don't file your ITR, you won't receive your refund. This is essentially money that you are entitled to, but you won't get it if you don't file your ITR. So if you don't file your ITR, you will not be able to carry forward losses to future years. This means you can't offset these losses against your future gains. Even if you eventually file your ITR, delaying it can have several consequences. So if you file your ITR after the due date, you may have to pay a late filing fee. This fee can go up to rupees 10,000 depending on when you file your ITR. So if you owe taxes, you have to pay interest on the amount due. This interest accrues 1% per month from the due date until the date of filing. So if you are due a refund, filing late can mean you lose out the interest which you would have earned on that refund amount. Certain deductions are only available if you file your ITR on time. Delaying your filing can mean you miss out these benefits. So filing your ITR is just not about following the law. It's about making sure you have the proof of income, avoiding penalties and maximizing your tax benefits. It's also crucial for getting loans, credit cards and visa. So make sure you file your ITR on time and choose the right firm based on your income sources. Thank you for watching the video till the end. If you found this video helpful, please like and share and subscribe to my channel for more such content. If you have any questions, drop them in the comments below and I'll be happy to assist you. See you in the next video, guys.